Possibly the greatest dividend growth stock over the past decade is Broadcom, stock ticker AVGO, trading at $1,389 per share as of right now. Let's talk about what makes this company such a great dividend growth stock. If we jump over to my dividend breakdown tab, come over here and plug in AVGO and hit enter, you can see all this data is going to automatically load in. And the reason this data can load in is thanks to the ticker data add-on in Google Sheets. And you can download all these spreadsheets as well on tickerdata.com at the link in the description. But again, we can see the company currently has a low starting dividend yield sitting at about 1.51%. So how could a company with a low starting dividend yield be one of the best dividend growth stocks? And let me explain. If we look at the yearly dividend payouts for this company in 2013, it looks like they paid out around 88 cents per share. If we jump forward to 2023, they paid out $19.05 in dividend payments, and after their most recent dividend hike, they're now expected to pay out $21 in dividend payments in 2024. So this company has seen absolutely explosive dividend growth during that time period, and here's what's so impressive about that. If we jump over to Seeking Alpha, click on dividend yield and scroll down, look at the dividend yield on cost over the past 10 years. Basically, this is saying if we would have invested in this company 10 years ago, our dividend yield on cost would now be sitting at 32.76%. Imagine getting paid $327 for a one-time $1,000 investment. And that doesn't include if we reinvested our dividends during that same time period. So the dividend growth rates have been absolutely phenomenal from this company. We can see a 10-year dividend CAGR of 32.81% and a 5-year dividend CAGR of around 13.4%. So absolutely explosive dividend growth. Now, to increase dividends at a rate that high, there's a couple of different things that the company has to do. Now, first off, they have to have a healthy free cash flow payout ratio. If we come over here, we can see the free cash flow payout ratio for Broadcom AVGO sitting at 43.36%. And if we look at it over the past decade, it's stayed in that pretty healthy range. It looks like for the most part, it's stayed in a range of around 25% to around 40% over the past decade. So really not too much volatility. If we look at this charted out, again, we can see it got as low as around 23.65% in 2015, and at its highest, it was at around 47% in 2020. So that's a pretty healthy free cash flow payout ratio. But again, if the company is increasing dividends at a very rapid rate, for their free cash flow payout ratio to not spike at the same time, the company has to rapidly increase the amount of free cash flow they're producing every single year. And look at that 10-year free cash flow CAGR, 43.21%, and the 5-year free cash flow CAGR at 20.59%. Now we need to understand there are 5 different things a company can do with free cash flow. 1, they can reinvest back into the business, they can buy back shares, they can pay out dividends, they can attempt mergers and acquisitions, and of course, they can pay down debt. So all of those are a great way to drive long-term shareholder returns. And so when we look at the free cash flow generated versus the dividends paid out for AVGO over the past decade, look at how the free cash flow has exploded. If we look at the blue bar chart, again, very consistent and reliable growth over the past decade, and the dividend growth has followed it, and the free cash flow payout ratio as a result stayed in a very healthy range. So when a company rapidly increases free cash flow, increases their dividend payments, and the free cash flow payout ratio stays in a healthy range, not only do we get phenomenal dividend payments from the company, but the share price follows as well. If we jump back over to Seeking Alpha and look at the past 10 years, we can see AVGO up over 2,000%, and over the past year alone, up over 115%. So personally, I do own AVGO in my personal portfolio. I added when it was around $515 a share, and we can see since then, my position in that company has grown over 171%, nearly 172%. So this is a great example of a company that has been a compounding machine. Again, all the returns a company can provide are going to come from free cash flow growth. We want to look for companies that can rapidly increase their free cash flow so they can reward us in the form of dividend growth, reinvesting back into the business, and buying back shares. And so when we look at the company now, yes, it trades at a much higher price than it did just 1 or 2 years ago, but that free cash flow payout ratio is still in a very healthy range where the company can continue to reinvest right back into their business. So when you look at the fundamentals of this company and these dividend metrics, it's quite easy to see why this company has been possibly the greatest dividend growth stock over the past decade. As for me, I haven't added shares of this company to my portfolio in a while, but I've been happy to see the huge run up in share price, and I've definitely been reaping the benefits of it in my personal portfolio. Now, like always, if you'd like to be able to download any of my spreadsheets and also get access to the ticker data add-on in Google Sheets that allows you to automatically import stock financials straight into your spreadsheet, then you can head over to tickerdata.com at the link in the description. But with all that being said, thank you guys so much for watching, and please don't forget to like and subscribe to the channel.